India Bonds presents CNBC TV 18, India's Fixed Income Summit.
So, the case for equities is often made at conferences like this. The case for bonds is not made often enough, and I think that's what we're doing here. So it's great to be doing this. But is that sort of, in your assessment, how people view bonds? I mean, either the long-held view always has been that, well, either chase growth, buy equities, or go absolutely safe, and then you sort of start thinking about fixed income. So has that balance started to come through, in your opinion, with how people think about, how investors think about fixed income, about bonds?
If you look at the overall asset allocation of investors, and especially when you look at through the mutual fund route, I mean, you distinguish between retail investors and institutional investors. And when you look at how asset allocation has happened over a period of time, retail investors are increasingly tilted, and they've continued to do so by way of either equities or hybrid funds. But if you look at, say for instance, ETFs also have increased over a period of time. But if you look at fixed income, I mean, as an asset allocation, it's been significantly minuscule. And if you look at the money that's lying in traditional bank deposits, it's significantly higher. But when you look at overall asset allocations for investors, and when you put money in a bank, I mean, of course, banks also look at their asset liabilities, right? And when they look at their overall assets and liabilities, typically you have, and Lata alluded to that earlier in the conversation, that you have floating rate linked assets, which is significant in your balance sheet. And to fund that, your overall requirement of funds is broadly concentrated in the shorter end. So that's why when you look at your bank FD rates, your bank FD rates are primarily the best in the 1 year part of the curve. But that is something that suits the asset ALM of the bank, right? But when you look at an individual, when I look at my asset allocation as an individual, of course, we've seen the euphoria of equity markets post-COVID, and we've seen a significant amount of returns, significant amount of leverage. But when I look at an overall asset allocation, and if I have an asset liability requirement, then you sort of try to blend your asset liability requirement based on the underlying balance sheet of the bank. But if you have a specific requirement, say for example, if I want to buy a car 6 months down the line, if I want to buy a house and I want to accumulate funds, say over a 5-year period, because I have a plan in the future, the rates that markets offer, and Suyesh, Amit, they've referred to dislocations in the bond market right now, is significantly higher. And at the same time, you don't get exposed to the kind of refinancing risk that's there when you are sort of looking at investments. And when you look at the rate disparity between what the traditional bank deposit offers and what markets are currently offering, there is a huge disparity, because when you look at the underlying markets, when you look at, say, for example, Awaaz, and which is again seeping through into the overall credit markets, the disparity between rates is quite significant. You have overnight rates which are ranging, within the lower end of the LAF corridor, between 5 to 5.25, and at the same time you have CD spreads, AAA PSU, which are ranging. At least for 3 months also, you are having spreads at close to 225 basis points, which is quite significant, as close as a crisis period. So when I look at myself as a retail investor, if I have, for example, a short-term requirement, why don't I try to maximize that and try and at least get that benefit into my own balance sheet, and at the same time get my liquidity at a time when I really need it? So if I have a requirement, say 3 months down the line, but what if there is a requirement to take money, say 5 days before, the liquidity availability which is there for mutual funds and the kind of products that are available across the suite, that's sort of something that investors can always harp on and try and maximize their overall gains.
So the products are there, right? I mean, across the mutual fund ecosystem. That is absolutely correct.
Yeah. So if you look at how SEBI has categorized and rationalized overall mutual fund schemes on the fixed income side, so there are two parts to it. One is where specific schemes are linked to duration. Right? So, say for example, a liquid fund can invest in securities which are up to 91 days. You have 3 to 6 month buckets, 6 months to 1 year bucket, and up to 1 year like a money market. And then you have on the duration side, so right up to a overnight requirement of money wherein you get a direct pass through of TREPs. to a long duration product wherein you have, say for example, and it's really dependent on how you look at it, right? So if a senior citizen, say for example, I'm closer to retirement and I want a fixed income corpus, but at the same time I just want to lock in yields for a longer period of time, I can have a systematic withdrawal plan, invest in longer duration bonds, and rely on the income that I received out of that. And yields are extremely attractive at this point of time. If you look at 30-40 year GSEC, you are at closer to 770 levels on a semi-annual basis. Annualized basis, yields are higher. So when I look at the spectrum of themes, one is on the duration side and the other is on asset allocation. So you have money market funds which are meant to look at products, underlying products or securities which are only up to 1 year. You have banking PSU, which looks at only high quality banking and PSU stocks, securities. Then you have corporate bond funds and so on and so forth. You have another category which is a dynamic bond fund wherein you rely on the asset manager to take duration calls or credit calls on your behalf. So spectrum of products are there. It's already available. The only need of the hour, and through you maybe I can make this request, is that more and more investors should be able to make use of that, take benefit of it, and try and ensure that their overall requirements of liquidity over a period of time is aligned perhaps to the underlying duration of the fund either, or if you are an aggressive investor, you can try and maximize your overall gains also, because when you look at the underlying sort of schemes, it's a direct pass through of underlying valuations that are there. So when you have interest rates which are extremely elevated, not reflective of the current market conditions, and at that point of time when you start seeing, say for example, resolution of the conflict or yields start cooling off because of, say for instance, dividend pass through to the economy, broader economy, and with that yields start cooling off, you get a pass through of that also, and at the same time you can use that to sort of look at asset allocation on other asset classes, or at least meet your overall requirements.
So it's an awareness issue, basically, Basant. That's what, it's an awareness, the messaging,
yeah, so if you,
it's not been sold well enough.
So yeah, if you look at, say, tier 1 cities to tier 2 cities, the asset allocation is quite different. You look at top 30 cities versus cities below. The asset allocation is significantly higher for top 30 cities as compared to the bottom cities. Similarly, when you look at retail investors versus institutional investors, the asset allocation of retail investors are primarily concentrated towards, say, equity hybrids and so on and so forth. But if you look at institutional investors, they are the overall asset allocation is quite balanced between debt, between equity, between
My
ETFs,
question
so on
though
and
was
so
more
forth.
retail. I mean that category. Institutions, yes, I mean they're well balanced. But my question was largely focused on what.
Yeah, so I mean, at a time when as
And
Suresh
yes, there is a
also-
taxation issue, and perhaps that gets sorted out, etc. But we're saying, well, at some point that will get corrected. It won't stay like that forever. But what needs to be done, in your opinion?
So yeah, fixed income markets, of course, are complicated. So Suresh alluded to this as well during his remarks that, how do you sort of explain, I think it was Datta who alluded to the fact that, you talk about yields and prices and you put disclosures around it, right?
That we do, as she said, with every piece. But yeah, go on.
Yeah, but if you look at the underlying theme, now SEBI has made it so simple, and it's a matter of, time wherein you have the underlying youth coming into the economy, understanding more complicated products. But at the same time, when you look at the underlying classification, what SEBI has done, you look at classification by way of duration, while you look at mod and macular duration, all of that. But if you just simplify it and you talk about, if I have an investment horizon of 6 months, if the fund is operating at a 6-month duration, just try and simplify it and talk about yields which are prevailing at, say, for example, today, close to 770 to 780. And you look at traditional fixed deposits, which are at, and it's very simple message to take, right? So you have fixed deposit, 6-month FDs are about at closer to 6% or perhaps below that, right? And the underlying instruments in which you are investing is actually the same as the bank that you are placing your FDs with, right? So as and when you start having that understanding that, once you get liquidity, second you get better yields, at least 175 to 180 basis points, or if not higher as compared to a traditional FD, and you get the taxation sort of incentive also, in the sense that, in FDs, if you are placing FDs for a longer period of time, your taxation is, of course, quarterly, and then, your compounding does not happen on the overall amount, whereas in mutual funds, you get compounding continuously till the time you don't actually take the money out, right? So from that perspective, there are multiple benefits to it. It's perhaps an awareness issue. And by way of you, I mean, that's something that all of us need to work upon. And we've seen success stories, right? We've seen SIP Sahi Hai working out, and you've seen retail participation growing immensely on that front. Of course, taxation goes a long mile in increasing, the appeal of these products. But at the same time, traditionally also, if you look at the core of the product, it still is very attractive.
It has product innovation sort of, leaped ahead, far ahead of adoption itself? I mean, is just innovation in the space, product manufacturing, I mean, the kind of stuff which is happening. The variety of products available in the fixed income space, as you said, alluded to, I mean, is vast, right? Are we seeing a fair bit of innovation here as well within these products?
So, the categorization itself is, quite diversified in that sense. But we do have, some mix of equity and debt products. You have, of course, hybrid funds that are there. But along with that, you've now had the SIF category wherein you are looking at generating additional alpha by way of use of derivatives on the equity side as well as on the debt side. So innovative products are coming in. And now, you have that benefit of not just relying on derivatives for hedging, but be able to generate additional alpha by way of derivatives as well under portfolio. So you have innovative products that are coming in, but the key message is that, you need to first increase the overall participation in the traditional products itself, right? And the underlying products which get more and more complicated, you first need to build those bases for the first line and then move towards introducing complicated products. So broadly, what is happening right now is that these sort of products are meant mainly for institutional investors because they understand the risks, and that's why there is a threshold also to the amount that these investors can invest. There is a minimum threshold because you expect that these investors understand the underlying products and the risks that are involved in those products.
What is the one sort of mistake that you see? I mean, throughout your, what is the most common mistake people make when building long-term portfolios, trying to achieve this balance between growth and stability in their portfolios? Basant.
If I want to keep it short, don't look back and make investment decisions. There is a lot of opportunities that lie, but you don't need to be clouded by what's happened in the past. So if you've seen a lot of volatility in the recent past, you look at the fundamentals and you see that there is still a lot of value. Let me just give you an example. Now, over the last 3 decades, on a decade-on-decade basis, you've seen inflation become significantly lower over a period of time, right? And when you look at the next decade, and you look at, a product which sort of beats inflation, you look at long durations, for example, 30-year, 40-year papers at closer to 770. And if you consider the next decade as a 3%, 4% sort of inflation, what is a risk-free product that beats inflation by closer to 370 basis points? Right? So fundamentally, if it makes sense for you, it makes sense for you. But if you look at the past and you say that, yields are going up, markets are uncertain, but over the next decade, your economy is still very strong, right? So you look at an underlying asset allocation and you invest, that sort of perhaps is of more value rather than timing the market.
I think that advice holds true for equity as well. Don't look back, look ahead when you invest. And as you said, perhaps, a nice slogan for bond markets, right? Like as you said, SIP sahi hai, mutual fund sahi hai. We need equivalent of that for bond markets as well. So maybe we'll come up with something. Thanks very much, Basant, for a great chat. Appreciate you joining us here on stage. Thank you very much.
Thanks, Prashant.
Thank you.
India Bonds presents CNBC TV 18, India's Fixed Income Summit.